Today we're going to talk with Melissa Calvin. She works for Superior Credit Union. It's a lender that we have done business with before and has provided some very good lending for us. And she's very knowledgeable about the lending space, and we're happy to share what she has to say.
Melissa, thanks for joining us today.
Yeah, thank
Appreciate
you for having me. I appreciate it.
taking the time. No, we're excited to have you and talk some lending and deal structures
Yes.
and from the banking world. Superior Credit Union, tell us a little bit about yourself.
I am a commercial lender, Superior Credit Union.
Yeah.
I have been in banking a little over 25 years. So
Gotcha.
started with a very large bank, actually as a teller out of high school.
Okay.
Worked through all the retail positions in the branch, intrigued by lending, so got into consumer lending, mortgage lending, and then about 5 years ago went full-time commercial lending.
Gotcha. All right.
So you went all the way through.
Yeah,
Started at teller, and that's
I have
awesome.
kind of seen a little bit of everything, which plays a big role in what I do now. So it's a
Yeah,
good understanding of everything that goes on in the branch.
How do you
Right.
like the difference between working at a big bank versus, you worked at, I think when we first talked to you, you were working at Metamora, right? Which
Yes.
is a very small bank.
So I have worked at very large Chase for a little over 12 years, and then small community banks, as you said, and now credit union. So
Yeah.
I kind of have a little bit in each of those three worlds, which is all the financial institutions pretty much.
Right.
And there are some differences. I would say credit unions and community banks are similar, that they focus kind of on their client, their member.
Right.
Big banks have a lot of great services, but they are big. So
Absolutely.
you kind of get lost in a big pool of people. That is the differences. The products they can offer can be different too. But here at Superior, we are able to pretty much offer anything a big bank can offer.
Right.
So, what is, okay, at least for me, I didn't know the difference between like a credit union versus a normal bank or whatever. Like,
Sure.
what's the difference between those two?
Okay, so banks have shareholders. So the mission of the bank is really to make profits for their shareholders, right? You want your shareholders to be happy. Credit union is not-for-profit member-owned, meaning you're a member of the credit union. So to be part of that, you just have to keep $5 on deposit in a savings account. That is your share of the credit union. So instead of giving profits back to shareholders, we take our profits and we invest them back into the communities and members, meaning lower fees, better interest rates. So we give that back. We don't have any shareholders to pay.
Gotcha.
Just the people who do business with the bank.
Right, because they are members, they are owners of the credit union.
Do you see any difference between, you've worked in both, true banks and then credit unions, do you see any difference in like, their ability to be flexible on different things or like give different lending or anything like that? Is there anything different, or is it pretty much they're both the same, or is one more advantageous to work on? Or
And it can be a difference in all credit unions. Some credit unions are very small. We are pretty large, so we're able to offer a lot of different products that maybe smaller credit unions can't offer. Like we do have a good commercial side. Some credit unions are not able to offer that. Some credit unions are not able to offer and portfolio their own mortgages. We have the option to do secondary market or portfolio those. We also help other credit unions with their mortgaging. So I think it depends on the size of the credit union, what they're able to offer. They do try to do anything that's going to help their community grow. That is, one of the missions of a credit union.
so you invest in your community as well?
Yes, we try to give back as much as possible we can.
What might that look like?
It could look like a lot of different things. We do volunteering, just projects. I'm involved in a ton of things in our communities around here, nonprofits. And again, it's back to the fees and the interest rates. We try to make financial success possible for all of our members, whether that be lending to them, paying them higher dividends. So it's multiple ways we give back.
Yeah, absolutely.
You mentioned, just for clarity, when you say portfolio versus secondary market. So portfolio being when you keep that loan in-house and you service it
We
in-house,
hold that, yes.
as opposed to selling it on the secondary market and then your loan's being serviced by whomever acquires that.
We normally service them still,
Sure,
even
okay.
on the secondary market, but you're right, it will go out to that secondary market mortgage. And we only do that with a residential.
Gotcha.
So on our commercial side, we portfolio everything that we have.
Okay. I think something that, at least when I was getting into real estate, or something I hear quite a bit, is a lot of people don't understand the difference between commercial lending and residential lending or like retail lending, or I don't know the exact terminology for it, but basically when you buy a house, you're getting a different type of a bank loan than when you're going out and buying a 40, 50, 100 unit apartment complex.
Correct.
And can you explain the difference between that and maybe the difference in underwriting or how it all works or
How the picture's kind of looked at that way.
yeah,
So-
how are they different?
Residential mortgages are structured with longer terms normally. So you'll get anywhere from usually a 15 to a 30 year with a residential purchase. As in comparison to on the commercial side, you are going to get a shorter term. It's usually, most financial institutions will offer 15-year. They can amortize the payments longer, but
Right.
your term will actually be 15 years, so it will balloon out at that time. So that's one way the terms are different. Underwriting is a little bit different as well. So when you're looking on the residential side, we look at your income.
Right.
So we're gonna take your income and we're gonna take your debts and we're gonna get a debt to income ratio. So you would take your debts and divide it into your income, and that would give us your percentage of debt to income.
Sure.
So we would look at that, and based on any financial institution's parameters, and most of them have about the same, but a little bit leeway of difference, what percentage they want. On the commercial side, we're gonna look at debt service coverage ratio, which means we're gonna take the net operating income and we're gonna divide it by the debt that needs to be serviced. And that ratio is, normally financial institutions are gonna want you to be at a 1.2 to a 1.25. That's where they have their comfort zone. Meaning if your debt service coverage comes in at 0.95, that means you are able to cover with your net operating income 95% of your debts. So that would make an institution a little leery to lend anymore if that's all you can cover. It means you don't have that room to cover any additional debt.
Right.
So if you're coming in at that 1.25, that means you can cover 100% of yours and a little bit more, which makes you look really healthy and good.
Right.
Gotcha.
So if that's an explanation of the differences between the two.
So when it comes to like residential lending or personal lending, you know, you're talking about debt to income ratio. So the income is basically your W-2 job, typically.
Yes.
Right? And it's generally pretty hard, at least I've experienced, it's definitely a little bit more challenging to get a conventional home loan or a personal loan like that. Say if you have your own business, right? Like W-2 really helps out because it's very black and white. It is what it is when it comes to residential.
Yeah, it makes the puzzle easier to put together if you have a W-2. We work with a lot of business owners, and we have a great underwriting group that does do tax analysis and credit analysis. So they'll take your tax return if you're a business owner and pull apart as much as they can, to figure that out.
Sure.
But you are right. So W-2 wages it's black and white, like you said. You pull a number, and then you're going to take the debts and divide it into that.
Yeah. So your ability to borrow, the amount that you can borrow in loan, is determined by basically how much you make when it comes to personal, right?
Yeah.
So the value of if you're trying to go buy, 4-unit property, that still would qualify for a conventional home loan, but your income is very important in order to qualify to borrow the amount of money for the personal home loan for that property.
It is. And I'm not as familiar as the loans on that side, because on a 4-unit, we could still look at it on the commercial side as well.
Yeah.
But you're right, especially if they're just getting into rentals, new to rentals, hopefully they're gonna be credit strong themselves personally, because that's gonna be weighted
Yeah.
on the decision.
Versus commercial, where your ability to borrow is dependent on the income of the property.
Right.
Yes, so we're gonna look at, and there's still a lot more that we look at, but that is definitely a good strength that you need to have, a solid property, and that the rents flow through, that it's gonna cover the debt that you're taking on from it.
Sure. So when we come to you with a property, right, and we're like, hey, Melissa, we have a property, you need to lend us on it. What are the things that you guys are going to run through and be like, okay, we want to make sure it has 1.25 DSCR.
Yes.
What else are you gonna wanna look at?
Like I said, we're going to look at, it's a huge puzzle that we put together. We do look at the strength of the property, sometimes location. We're going to look at what your occupancy is already, like so how many vacant apartments you have that you need to fill,
Right.
and does that seem doable?
Yeah.
Solid on the property, I mean, is it in great condition, or are you going to have to spend a year and a half rehabbing that
Yeah.
property?
Right.
That's kind of a big deal too, or is it rentable right now
Yeah.
and people in it? Again, debt service coverage, we do look at that because we want to make sure that you're going to be able to handle that debt that
Yeah.
you're taking on.
Right.
And in a lot of circumstances, you know, we have guarantors still on the loan. So there are people that are still going to stand behind it. We want to know who's managing it. That is a huge deal. Do you come with experience?
Yeah.
You're going to come in and buy a 100-unit rental
Yeah.
and
Never done it before.
you've been working in the restaurant business, you know, for 20, we're going to say, okay, this may be more risk for us because
Yeah.
are you going to be able to handle what you're taking on? Even if the financial part looks really good, we still have to say, you know, are you going to have property management? Are you going to have someone that helps you, or who experience is going into that deal with
It's
you?
kind of the intangibles that are very important in a business, outside of
Yes.
just the numbers.
Right, like I said, it's this huge puzzle,
Yeah.
kind of putting it all together. But
Right.
that service coverage ratio is probably one of the prime things that
Yeah.
we're going to look at.
And then you look at the people who are, in our case, when we sponsor a deal, when we're bringing a property to you to invest, you also look at, like Nate and I are the partners of Rust Belt Capital. You look at what our income is and what our portfolio income is on, you know, that's a secondary level on determination of whether you like to make this loan or not, right?
Correct. Yep, so we're still going to look at you personally because you're going to personally guarantor the loan.
Yep.
So yes, we look at your credit history, we look at what your income is, how you've done with your own personal debts, you know, your payment history, your assets, those type of things. So we're going to still look, not separately at you, because we'll still look at it globally is what we call it. We look at the business by itself first, and then we're going to bring you in and see, I mean, if someone would come in and really have bad credit and not have any income and they're jumping into this business, maybe the business looks good, but them personally may bring that global down to where it may be something we have to question.
Yeah, yeah. Could you explain, like, what a guarantor is? So that's something that's pretty important that maybe people don't understand is conventional home loans, to my understanding, they're non-recourse, meaning if you don't pay your loan on your house or whatever, yeah, you can lose your house, but if they go and they sell the house and they loan you $200,000, the house sells for $100,000, they're not going to come after you for the other $100,000 generally.
Right.
But on the deals that we do, okay, if we go and say, hey, Melissa, can we borrow $2 million? And we borrow $2 million, and then, you know, something happens and you sell the property off because you took it back because we didn't pay you or whatever, and you only get $1 million of your loan back, you're coming back to us, right?
We're going to try to recoup.
Sure, and
that.
I'm gonna jump in there for a second because there are some states that are non-recourse on the
Yes.
residential side, but in Ohio, that lender can go after the homeowner who defaulted on their
Really?
home loan. Absolutely. As a practicing bankruptcy attorney, I can tell you so all the time.
Yeah, actually, they can seize your assets. Yes, if they need to recoup a difference, like you said, if there's a loss, if they sell the house and they didn't get everything that's owed on the balance.
Right.
And we don't do really any non-recourse. So,
Sure.
like I said, especially commercial buildings. So if we had a big commercial building and it sold not for enough that we owed, we would recourse. We would go after your personal assets. So when you're a guarantor,
Yeah.
you are really
You're
hopefully
right.
believing in that business and going to work your best to make it work. Because if not, you are going to be liable for that loss.
So
Right.
that's how you could see a potential advantage for people working with us or investing with us if they want to get into investment real estate on a scale that actually is going to make a difference to them in their retirement and their life. They're not the ones, the way we run our shop, they're not the ones that are guaranteeing the loan. They're not having to sign on that. And that's
Right, you
potentially
guys are
having-
standing 100% behind it. I mean,
Yeah.
you're putting yourself 100% on the line too.
Yeah.
So, yeah, so that should speak volumes for you, for your business, because you're right, you're putting yourself out there.
Yeah, it does give investors a way to get into real estate exposure in their portfolio without taking that personal guarantee, which,
Right.
yeah, you go buy a rental, a duplex or whatever, to run it on your own, and that's gonna have a personal guarantee, I'm assuming, in the banking
Yes.
world, particularly if someone hasn't done it before, or they're not putting
Right.
50% down or something outrageous and getting, because what would be, let me ask you that, on a commercial acquisition like this, is there a debt to equity ratio or whatever there, that debt to value, or loan to value, I guess gets to find the right language, where you wouldn't require a personal guarantee?
Every deal, I wouldn't say there's any number I could throw at you.
Sure, okay.
We look at every deal so individually because everyone is so different.
Sure.
I would say, from my experience, we're always going to have some type of personal guarantor on it.
Gotcha.
Just so you know, somebody's, got their hand in it that
It
believes in
matters
it,
too. Yeah,
that's
yeah.
going to put themselves behind it as well.
Fair.
There are not many times that I would see, unless it's such a well-established business that's been years and years. You can negotiate other things, though. If you have a super
Right.
super low loan to value,
Right.
that benefits you other ways. I mean, sometimes that'll negotiate your term or your rate or,
Rate or your length of the term, sure.
right. So, I mean, it can give you some negotiating
Gotcha.
room.
Here's a question. Here's something that I've experienced before, and I just want to get your take and your opinion on it. I've found that it's way easier to get a commercial loan for $1 million than it is for $100,000. I've literally had this actually happen before, but from the perspective of a banker who needs to place capital, right? Like, you guys make money by
Selling money.
by selling money, essentially.
Right.
And doing so wisely, it's going to move the needle and matter a lot more to you, right, to move $1 million and spend the same amount of time figuring out if I should lend $1 million than if I should loan $100,000, right?
It is about the same amount of work that goes into each deal. That is very correct.
Yeah.
So, I mean, obviously, the high dollar is going to make more.
It's going to catch your attention faster, probably.
Yes.
Yeah. It may be, I know they're probably not going to want you to say that it's like give you better terms or anything, but like, it's probably easier to advocate for somebody coming to borrow when they're borrowing more money to get the extra 25 basis points, or the extra, instead of 5 years fixed, it's 7 years fixed, if it's a larger sum of money and it's on a bigger, more established project.
I would say that's probably correct, along with what's behind that, that million. Is it?
Assuming, apples to apples.
Yeah, good guarantor, solid building, solid rents. Yes, I would say the larger amount would be, again, a negotiating tool.
Yeah, so from your perspective, would you say there's value in what Rustbald's doing, in the size and the scale that we're putting together and continue to put together for our clients, that it's more likely than not we're going to be able to go out and find better debt than they would on a smaller project that they're going to do independently when we do a bigger project and we're talking to you and other bankers and we're standing behind it, and then you can see our track record and our portfolio and stuff.
Yes, for one, you guys do all the investigating and the research, and it's a lot that goes in. I know when you're looking at a property, you guys look at every detail.
Yeah.
You look at it like the bank looks at it before you decide to purchase it. Really, you guys kind of tear the whole deal apart and see, the worth in it, if the rents flow the same. And you come with a lot of experience. So yes, I would think if someone wants to get into investment properties, sometimes pulling that money together and letting someone else be able to get a bigger deal, especially that comes with experience and knowledge. Yeah, I think it's a great idea. It's a lot of work to get into rentals. If you don't have a lot of knowledge behind it, and not that they wouldn't have knowledge, but what goes into having a 50 to 100 unit property, that's different than having a duplex or
Right.
it's
20 single-family houses.
right.
Yeah.
It is a lot.
I appreciate what you said there, that we do the effectively our own underwriting, which is really what
Yes.
it is. But are you telling me that some people come to you and have not done that homework?
Yes. Yes, I am.
That floors me a bit.
And right now, investment properties are hot. I mean, that's a hot item in the market. So we have, and I work with a lot of people, out-of-state investors that are coming into Toledo, because Toledo's
Okay.
a really great area. It really is growing, doing well, and they're purchasing their first, in my mind, I know someone out, which is a 4-unit.
Yeah.
And they've never owned a rental property. I mean, they are asking me questions on collecting rent. So that signals to me that maybe we just need to research this a little bit more. Maybe you need to do a little bit more. But yes, people want to jump in because it's talked about, I think,
So
a lot.
easy. It makes,
So
Passive income, right?
Right.
That's
yeah,
what it-
and that's what everybody, like I said, they want to jump on the train before they do their homework. And it still is a lot of work. There still is a lot of things that you need to look at. And like you said, you guys do your own underwriting.
Right.
You came to with me with great numbers, a lot of things that probably saved me a lot of time, to be honest with you, because you did that much research, and which is great on a larger unit like you have. That's required. I mean, if you want to be successful and know that you're stepping into something that's going to be good,
Right.
you do all that homework.
So just to let people understand and know what Melissa's talking about, when we look at a property, we go and we underwrite the deal, just like similar to what a bank would do. And so we'll look at what is called a trailing 12. What has the property done in the last 12 months? And typically, we want to know what it's done in the last 24 months financially in terms of rent. And then we'll put their numbers in and come up with a valuation based on their numbers. And then we'll know what we can operate it for, and then what we believe we can grow rents at, and we'll do what's called a pro forma. So that's projecting out how the
Right.
property's going to operate over the next 10 years. And we always try to be very conservative on that. And so we'll put it into an Excel spreadsheet, and then we'll see what our equity makes, because we're equity investors, and we'll see what the debt service coverage ratios look like. That way, I don't waste Melissa's time and bring something that's just not got a shot, right? Plus, like, that's a risk mitigation tool. Like,
Right.
if I'm looking at something and it says we have a 1 DSCR,
Right.
I'm probably not excited.
I don't
about
like
it.
that deal.
Yeah.
Right.
Yeah.
Right? There's got to be a really compelling story to follow up on that.
Right.
But then I'll give that and I'll show it to you. And so, how much does that actually help you when I just give you basically our Excel underwriting on what we're doing?
Oh, it's great information. For one, like I said, you've done a lot of research that I'm already going to have to look at anyways. And we still double check all that, but you're spot
Yeah,
on.
please do.
I mean,
Right, please do.
yes, we still do all our own underwriting, but when you come to the table with that, for one, it shows experience, it shows knowledge, so that makes, for one, me less apprehensive because you already show that you know what you're doing.
Right.
And then I obviously will look at the property, the rents, the occupancy, just all the things that you're going to have on your spreadsheet that you have there. It weights heavy. It lets me know that, okay, that's probably the green light that I can keep proceeding. Because there are deals that are put in front of us, and I don't do the underwriting, but I'm knowledgeable enough to know if I should send it to underwriting.
Yeah.
If I send them something and they have, when I first started, came back to me and said, "I'm not sure if you didn't look at this closely, but it was a no-go before I should have known that."
Sure.
So now with that all in front of me, I already know that I have the green light. You guys, this looks solid. It looks good, and I'm familiar with you, so I know that I would go on to the next step.
So do you send that right away? Do you take our underwriting and send it to your underwriting, or how much of our information are you passing on to them?
I share everything,
Okay.
just because it helps for people to look at it and double check it. Anybody that has a prepared pro forma, it is a huge help because it gives us, we're able to make our projections
Right.
based on what rents look like now, what you're projecting, if you're going to be able to raise rents, if the occupancy is going to go up. So giving us that information is a huge help for our underwriting process as well.
Yeah. And honestly, for those who are listening, like, I would prefer the bank to underwrite the deal without even knowing our numbers. Not
Right.
because,
See if they come out the same.
see if they come out the same. It's a double check of risk. Like, we're really risk averse. We don't want to lose money. We're not in that business. So, like, here's what we come up with.
Right.
Melissa, is
It's
this
like turn
accurate?
your paper over. Don't look until you tell me your numbers.
Next time we take to it, we should throw in some red herrings in there.
Yeah. This is not a group exam.
Right, you can't look at my paper.
Yeah. So what are some things, some obvious things, this might be valuable for people, what are some obvious things that you can tell right away whether a deal is worth you looking at or not in terms of lending?
Again, all the same things that, I'm gonna first of all pull up the property and look
Right.
at the property.
What do you want to see in a property typically?
Like I said, it depends if it needs a lot of rehab. I mean, are they planning on gutting the whole building? Because that's gonna change, obviously, terms and our risk in that. What if you get only half completed? I mean, so we're gonna look at those even closer if we have to know there's gonna be no rents and someone's going in to do a bunch of work before they can get anybody in there. If the property's solid and already has great occupancy, that's a huge plus.
Right.
That way it just maintains through the whole loan, and then you only increase as you go. I'm gonna look at the people bringing me the loan, just to kind of see, like I said, again, their knowledge, if their experience with rentals. It is a big game to get into, and there are rules, and you have to know certain things to
Right.
make it successful. So I'm gonna look at that. And again, some people will bring deals like that and not want to be personal guarantors. To me, that's
Right.
usually a red flag, because if you're not going to stand behind it and that's going to worry you, then
Why are you doing it?
right.
Yeah.
So if you're the one bringing me the deal, I'm hoping that you feel good enough about it that you're like, I will sign my name.
Yeah.
So just all of that.
Yeah. So it kind of sells, and that makes sense because like we don't want to take on heavy value adds. Heavy value adds, exactly what you said. Like we got to go and completely gut this place. That's not appealing to us.
Right.
Right.
Or, I mean, Nate, we've seen properties recently that have like 70% occupancy,
Yeah, that's right.
and we're just,
It's wild.
yeah, and it's like might be a great property, but we don't want to take on that. We're risk averse. We don't want to take on those types of risks.
Right.
So it's knowing where you stand and like what risk tolerances you have, which I think that helps us out from a lending perspective, because hopefully we only bring you deals that you're like, man, I'm willing to compete on this one because this one's good and these guys
Right.
know what
Yeah.
they're doing.
Absolutely.
What's right now? I know there's a lot of things going on in interest rates and the Fed funds and all that type of stuff. I mean, it's April 2024, right? And sometimes I forget the year. But there's all this crazy stuff going on about interest rates, right? We saw interest rates go up, what, 500 basis points, 550 basis points or something like that.
Quite high.
And so that's screwed up a lot of operators in our business that have loans that are coming due. Banks maybe have now bad debt or debt that was profitable, but now it's, they got to do some
Less so.
Yeah, mark to market, and it's not cool if you're the bank. And so some banks are getting less or having less appetite than others. Like, what are you seeing? What's going on that?
In the market, prediction on interest rates, I wish I could give you, but everybody asks, and I always say,
Sure.
I wish I knew. I
Yeah.
would be in a great place if I did. I will say, on the commercial side, and I have a lot of banker friends. All bankers kind of gravitate towards each other in networking events. There are a lot of banks that are shying away from commercial lending just because getting in the deposits, a bank has to balance that
Right.
out. If you don't have the deposits, how do you do the lending?
Right.
So I think that has been a hardship for some financial institutions, is getting enough on deposit so they can continually take the risk to lend. And some have just become more conservative with the rates the way they are.
Right.
And business is harder to get, I think, with the rates, because sometimes people are not wanting to jump into the market or purchase something because. So I think it's a mixture of a lot of things. But the things that I've heard in conversations lately is they've just taken a step back from taking on too much. We are luckily in a very good position. We are still full force lending commercial, still looking obviously on the residential side as well. We're doing well, so we are able to still do all the lending.
What's the difference you're seeing in terms of real estate volume this year versus last year?
On the commercial side,
Yeah.
it's been a good year for me so far. That has been 100% of my lending has been commercial real estate. So I've done a lot of investment properties. People are still out there looking. I think negotiating the deal has been a little tough because,
With the rate
because
changes.
yes. So I think getting a deal signed, and to me is the hardest part usually for people. Once they get to me, I'm able to help them usually. But I've seen quite a bit. Like I said, it's been a good year for me so far. That doesn't mean it's gonna not slow down because,
Sure.
I mean, it's been a roller coaster. I would say the last year, sometimes my pipeline gets really skinny, like there's not much going on, and then it's like the bus lets out. I don't, I wish I could say there's a
Sure.
rhyme or reason to it.
It's ebbs and
But we've
flows.
kind of been in the same market now for a year, wondering what's coming up next, and some people are just tired of waiting. So I think that's
Yeah.
probably been the influx of business I've gotten lately is they figured out that maybe if they have a good deal in front of them, something solid, strong, they should probably go after it because it might
Yeah,
not be there
might
next
be
year.
there. That's fair.
So, go ahead.
Before I forget, you had mentioned, and I think a lot of people maybe don't understand this, on the deposits that banks need. When people deposit money in their checking and savings account, right, that's what
Right.
you need. That's not exactly the same dollars, but you need a certain amount of
Yes.
cash on deposit to be able to make loans. And are you seeing that it's well, not necessarily superior, but general banking, is it because there's the same number of customers, members, consumers that just have less money, or are they moving? Are they taking their money out to move banks? You know, if it's an issue on the deposit side.
I think rate hopping is a thing. I
Okay.
think definitely people are intrigued if they see, the 6.5
Go
CD,
get that over
they're going.
Yeah.
On the bank side, I think financial institutions probably wrote a lot of loans that are at that 3.25 to
Yeah.
4.25, and then on deposits right now they're paying between 4 and 5%. So
Right.
it makes everything a little tighter. And you're right, we have to have a percentage against each other of deposits to lending.
Right.
So that's where like I said, I think the tightening is, and then the lower loans that we have wrote for that lower interest rate, and we're paying higher. So,
Paying out more than
like I said, it
the-
kind of makes you tighten everywhere so if everyone's fighting for deposits and trying to give the best interest rate,
Right.
but sometimes you can't pay that.
That gets tough.
Yes, it's kind of like gas prices. When gas stations start going, they really try to keep up with
Yeah,
each other,
yeah.
and depending on what your financial position is as a financial institution,
Yeah.
is how much, you're going to be able to have that leverage to beat the
The
next.
neighbor, yeah, gotcha.
Like we said in the earlier conversation, where we're at right now, if we can buy a deal at 7% or 6.75, and it looks good at that, then if interest rates go down,
Great.
we win. Interest rates at where they are now, with the consumer homes being about 6.75, 7% or something like that for a conventional home loan, and the tightness in supply of houses, it's very expensive to own a home today. I think it's the most it's ever been to own a home. So there's a lot of people who don't have the opportunity to go do that are now forced to be renters, right? So if you're looking at like a $250,000 or $300,000 home, you're looking at a mortgage payment of $2,500 a month, $3,000 a month total when you got your maintenance, taxes, insurance, all that type of stuff. That makes our $1,000 a month 2-bedroom apartment look
Pretty appealing.
very appealing,
Right.
right? So it keeps the demand pretty high. And I also think, if people they have those conventional home loans that are fixed rate for 30 years, they're locked in at 3% or below 4%.
They're not going anywhere.
So they don't want to sell those homes because now they have to buy at 7 or 8%. So now you've got the supply not increasing because these people are basically
Hanging on.
hoarding the home.
They're hanging
right?
on to them, yeah.
So that helps us out.
You can
because
downsize to half the house and have the same payment.
Exactly.
Yeah.
So that helps us out quite a bit. But like the deal we just did, if interest rates come down 1%, so if we're able to take the interest rate, we did the business with you. If we're able to take the interest rate down 1%, our cash on cash return to our investors goes up by 2.5%. So that's advantageous to us, and the value of the property goes up because the
Right.
borrowing cost goes down. So we're in actually a very good situation.
Can't forget the flip side of that is if interest rates would go up more. That's why we like to fix that rate as long as possible. Just the knowns. You can deal with it if you know.
Right.
If it's variable, that scares the life out of me. But if it's known and you've got 7 years to pay down debt, by the time you have to deal with a rate increase, if that was the case down the road, you've paid that debt down, you re-amortize, and you're really in good position
You're
to
still good and
continue.
solid, right?
Worst case, right where you were. I like that.
Is that something that, I mean, you see a lot of commercial loans. Is that something you see that's maybe a little bit unique about us? Is that we always ask for a long fixed rate period? Like,
Yeah, do other people push for that?
yeah,
as
typically,
much? Yeah.
typically it's 5 years fixed, right? Like a 5-1 arm.
Like we'll do a 5 and 1, 5 and 5,
Mm-hmm.
and I think 7 and 1. Is that?
Yeah,
Something.
but we're always like
It is different.
7 to 10.
I wouldn't say we get that a lot, but your explanation of it was very good because that makes from a business perspective, that makes complete sense, right?
Right.
The known is what you need. So now you're locked in, for 7 years. And
Right.
then who knows what interest rates will be at that point, but it doesn't matter because you know where you're going to be in 7 years. You'll be
Right.
in a position to handle it, whatever they are.
Right,
Yeah.
we go down, we win, they go up, we're fine, that's, yeah,
We've bought time on both ends. Number one, we have time to push rents, get them increased. Number two, we're amortizing down the debt, which buys
Right.
us the ability to afford a higher interest rate later
Right.
in terms of risk mitigation. So we don't want to be in the business of trading interest rates. Like that's not, our core business is not trading debt, right?
Right.
Our core business is running apartments, right?
right,
Basically.
right.
So I just wondered if you saw that quite a bit or not. I think it's something that is unique when I go to these conferences and I hear these other people, it's always this 5 years fixed rate,
Mhm.
and it's like the minimum we're gonna get 7. Like we're not gonna do a loan at 5. So I just wondered if that was unique.
It is unique. Like I said, I don't get that request a lot.
Yeah, and it's not maybe too terribly hard to push for that, is it? Or
Yeah,
a
on
little
your
bit?
end from the,
No, we'll
Right.
always be able to quote that rate. It may be a hair difference in rate. It may not be at all, depending on obviously the rest of the picture on negotiating.
Sure.
But like I said, that was a well-explained explanation. I may share that with some of my members that are trying to weigh out options.
yeah.
Just tell them to invest with us.
That's
Yeah,
maybe.
Perfect.
Don't do this deal with me. Go with them.
Especially with the California people. Then it'll come back to you in a bigger loan.
That's right, you're right, it'll all work its way around.
Easier,
Work its way
right?
around.
So you talked to a lot of other bankers. You guys, like minds circle around together. Are a lot of loans starting to come due? Have you heard that? Like those 5 years, the interest rates are starting to reset, and how are they handling that?
I wouldn't say it comes up in a conversation a lot, but I did have a conversation a couple weeks ago with another banker, and they have had a couple requests. People usually call in nervous, anxious, trying to
Yeah.
figure out, because sometimes people don't even understand the process when they get to that point where their rate's going to adjust or if they're at a balloon point.
Right,
I think everyone's a little nervous, though, until they understand it, and no one's going to want a higher interest rate than what they
naturally.
set out. I mean,
Right?
no one wants to give any of their money away, especially to financial institutions if you don't have to. But we have seen some come due, yeah. And they're trying, everyone's situation is different. Some people have more cash to inject, so they're trying to structure the loan different so
Pay down
it
some
doesn't
debt,
hurt them as
yeah.
bad. Some people are not in that good situation and are just going to have to pay the higher interest rate. And as much as that may put them in a different position they thought they would be financially.
Right,
So one thing is we've seen properties, big projects come across our desk that are trying to get marketed or traded by brokers that basically the sponsor, they got caught out of position in terms of interest rates, and they didn't hedge their risk exposure to that well.
yeah.
And so now it's just time to sell. Have you seen much of that happening at all? Just people that are like, it might still be profitable, but not like it was, and let's just get rid of it.
I have seen a little bit of that, things being put on the market for those reasons. A lot of warehousing, and not so much rental properties, but some warehousing, and that's a whole different story, usually why that's happened. Businesses just aren't using properties like they used to.
Right,
As far as rentals go, I have seen a couple that I think maybe they bit off more than they could chew. It's
Yeah.
probably that, and then with the rates the way they are, they're barely breaking even because it's just either been mismanaged, or the rents didn't come like they thought, or they didn't increase rents. I mean, obviously
Right.
rents increase with inflation and everything else, so they, and it probably just didn't have the experience they needed before they jumped in on the property that I have in mind now that I'm thinking of. I think when they decided to do it, they thought it would be great passive income, and here we go, this is gonna be good. And it just didn't get managed as well as it probably should have.
Yeah.
Yeah, that's one thing that when we're looking to buy properties, we're looking to find properties that there's operational inefficiency, they're not managed like they should.
Right.
The leases are under market, so that's called
Yep.
loss to lease. We want to reduce that as much as possible. That helps you out as a bank. It secures, you're our biggest partner, right? You're the biggest
Right.
investor in any deal that we do.
Right.
So that helps secure your investment in the projects that we're taking on. Is there any other major things that you see going on in the banking world right now, or the lending world?
As far as the whole financial institution world, like I said, I see some people tightening up a little bit
Yeah.
on lending, underwriting, and what they look at, what they want it to be a little bit stronger than probably they would have required 4 years ago, maybe. And not as much to lend. Some financial institutions are just
Yeah.
finding themselves, it might even be to certain industries. You know, as a financial institution, like, we look at our portfolio and we say, well, we don't want out of the pie more than this in restaurants or this in gas stations. So some are tightening up because they have enough of that industry, so they're not able to lend anymore to our golf courses, you know, whatever it may be.
Right.
And because of deposits. Deposits is probably the biggest thing that I'm thinking of right now that's changed. We need deposits, and right now it's
Pinched. Yeah.
people are pinching pennies. They don't have as much to hold on deposit, and the people that do are chasing
Fighting
the
over the
rates.
rates,
So,
yeah.
yeah,
Yeah.
they're going around. So it's hard to get a deposit and to hold on to it.
Right.
Yeah.
Right.
So far, how's your, I mean, we've worked with you before, you've lent on some projects that we've undertaken. How would you describe your experience working with us, and how do you like working with us?
I would say you guys are very easy to work with. For one, you come to the table very well organized. You already know before I tell you. I don't even have to tell you what documentation that's needed. You're very well versed in that, so you already have packets of information that you know that I'm going to ask for. You've already done a ton of research, so putting that in front of us is makes me already go on to the next step, because I know that you're already solid. I know that you've done all that research on the property. I can see it in your pro forma. And your communication. I will say, I work with a lot of different people. Sometimes it takes 4 days to get an email returned. You guys are quick. You guys, if there was something I needed, you were just quick, turn it around, got me the documentation, got me an answer to my question. Very efficient. And you guys stand behind what you do, so that's huge.
Yeah.
Appreciate that.
So it's been very easy.
So for the record, there's no gun behind the table. The door is unlocked. There's no,
I'm not being held.
Yeah. The banks like working with us. Wow.
Yeah, you guys were a pleasure to work with. I hope to work with you in the future. Like I said, you're very good at what you do.
Thank you.
Definitely appreciate that. How can people get a hold of you to do business with you?
Well, if they go to Superior Credit Union's website, you can look up under business loans. You'll see my picture, my contact. I am at our office on Airport Highway, but my contact information will all be listed right there on the website, and they'll be able to get a hold of me.
Hit us with that website so we've got it for you. Just go ahead with Superior's
Yep.
full website.
SuperiorCreditCU.com.
Got it.
If you just Google Superior Credit Union, it'll come right up too.
Excellent. All right.
Sounds good. Well, definitely appreciate you doing this. You explained a lot. I've learned a lot, and I appreciate you coming out here.
Yeah, thank you. I learned a lot from you guys too, so I appreciate that.
Yeah, absolutely.
All right.
Sounds good.
That would be helpful.
Thank you.
Appreciate you.
Alrighty.
Thank you. Thank you.
Thank you.
All right.